Hey everyone, welcome back to the Real Estate 101 podcast. As always, I'm your host, Robert Leonard, and with me today, I have another Robert Rivani. Robert, welcome to the show.
Thanks for having me. Appreciate it, Robert.
Before we dive into your real estate specific businesses, I want to talk a bit about your footwear business that you sold for $150,000 when you were just a teenager. Talk to us a bit about that business and how it all happened.
Yeah, so to make a really long story short, I didn't come from much money growing up, and I wanted to create a side hustle to be able to make money to buy the things that most teenagers growing up want to buy: shoes, jewelry, if you can have it, certain clothes and whatnot. So I saw an opportunity to be able to buy some of these really high profile Jordan shoes that were selling for double on eBay if I waited in line overnight and was able to grab a couple pairs, or have a buddy with me to grab a couple pairs. We can sell them on eBay and double our money, and that could pretty much pay for me to be able to get a pair of shoes that I wanted for free. So that seeing that possibility turned out to if I could do this 10 times, 20 times, 30 times a month, it could be a real business. If I'm making 5-10 grand a month, I think I was 15, 16 at the time. You can't get much better than that in doing something you love to do. So one thing led to another. And, I got to a point where I was buying, like I said, 20, 30 shoes a month and selling it all over the country. And it got to a point where one person approached me, because I'd be like one of those sneakerheads where I'd have all my shoes stacked on each other in my bedroom, and I'd lick the bottom of the shoes, and I would have that whole hype going on behind it. And then one person, I just love your collection. It's too hard for me to buy this many at one time. So one person just stroked me a check, and he's like, I want to take them all off your hands. And that was the end of the business and the game.
Wow. And how did you transition from kind of that business eventually as you got a little bit older into real estate? And did you use that money to start investing in real estate?
Yeah, for sure. So I was doing property management in my younger teens as well. So I had a fundamental basic idea of how real estate worked from that gig. So it taught me a lot of the important things that you look out for when you come to buy a property. But like everybody else, when you see other people doing what you're doing, or transitioning from property management to being the developer, I see some people were making $500,000 to $1 million on a transaction at the time. Like, why am I in this to make 3% for management fees? Or, there's nothing wrong with a management fee company, but if you're really trying to equity build, having that kind of income stream is never going to make you $100 millionaire or a billionaire. So that's where that transition or that light bulb hit. I'm like, okay, it's time to pivot, and it's time to get into this the redevelopment game. And I did use the majority of my money into the first couple properties that I bought in Georgia. This was during the Great Recession time, when properties were actually affordable, not like today.
Before we talk about what kind of properties they were, how were you able to start investing in one of the worst real estate markets that we've ever seen? I mean, you mentioned the prices were a lot better than today, but just from a psychological perspective, you see all of these really quote unquote successful and experienced people running out of the fire, and then you're running in. So talk to us a bit about what your thoughts are going into that.
Yeah, so it's the mentality of, at least the mentality that worked for me was let's say, for example, somebody had a property that was once sold for, the property I bought was once sold for $2.1 or $2.2 million at its peak, and went through foreclosure, REO. The bank's like, hey, we just want to get rid of this property. And they were trying to sell for around $600,000. In the back of my mind, I'm like, okay, if it was once worth 2.1, 2.2, whatever the number was, and I'm buying it for 600 grand, I'm buying it 33 cents on the dollar. How much lower can a property of that magnitude with income go? There's a point. It's like saying, would I bought that property if it was 1.5? No, because even if the market does turn and things are really great, my spread is very minimal. It's 25, 30%. That's what normal people will make in a redevelopment. But if I could bring this back to 2.1, 2.2, and I'm buying it for 600, having a 350% return, that's exciting for me. So was I fearful? For sure. Was it good that I was a little bit ignorant and young too, and I didn't really know or understand the full grasp of what was happening? Like everyone in the Great Recession knew, hey, look, stuff's really bad, market's tough, things are really scary, foreclosures, REOs. But I was kind of young and naive, to be honest, and part of it, worked to my favor. It's like I was a gunslinger. I'm like, well, I can lease up the property. I'm capable of doing it. I could do it. And I just had that mentality, and it worked for me.
How did you go for, or why did you go right for that type of property? A lot of people that are younger or even just inexperienced with real estate, they'll start with a much smaller deal. They'll start residential, or they'll start with a single family or a duplex. They won't go for these larger commercial properties. What made you want to go for those?
Right. So the good thing was, like I mentioned, I had some experience when it came to the commercial side, to the property management part, so it wasn't as scary for me. Also, this building was only 6,000 square feet, so again, it's like similar to what somebody would have for a triplex or kind of development. So it wasn't huge, and I would never recommend for somebody to go into their first project or first property redevelopment into a big one, because you just need to learn the nitty gritty of it before you get into that. So it wasn't really that scary just because of its sheer size, and I had experience in the retail part of it. So the good thing about this property was there was only 3 tenant suites. So they already had a Dunkin' Donuts in one suite, had a dentist suite tenant in another suite, and there was 1 vacant suite. So for me, it's like, okay, if I could lease up 1 space, have the potential to make 3 times my money, I'm going to go knock on every single door in the entire city if I have to, until I find that right tenant to take the space. And luck had it, I was able to grab Jimmy John's to do a Jimmy John's drive-through there, and they were excited. Even though the pandemic the recession hurt them, they were still doing business and they're still wanting to expand. So I got lucky / hard work and pounding the pavement and knocking the doors, versus a lot of other people just put up a lease sign and they hope and pray that a tenant will come to them. And for me, that never worked.
My camera that I'm using for this makes the background nice and blurry, so it makes it look a little fancy. But if you could read it, the sign behind me says, "The harder you work, the luckier you get." And so, I mean, it's one of my favorite sayings. It's exactly what you just explained.
Yeah. Look, I took the Jordan shoe mentality of never giving up, sleeping on pavement overnight to try for shoes, just to go knock on every single door and not be ashamed and say, "Look, this is the kind of stuff I have. This is the property I have." And during those times, everyone was struggling, and the tough part for a lot of these businesses when the market was on fire. Not to get too much into detail of rent, some of these people were paying mid $30 a foot rent. Versus I was offering a similar product for like $18 a foot rent. But the only reason I could do that was because my cost basis was so much lower than that other guy. So the tenants were excited and saying, well, I'm almost saving 50% on rent and I get a newer looking property that the owner's going to put money into. So it's kind of win-win for both sides in that sense as well.
We're talking about the Great Recession. Now I want to talk about another time period that might not have been as difficult as then, but was still been difficult for a lot of people nonetheless. And that's COVID. If you go to your website, the very first thing you see is a short video clip that says delivering best in class retail, dining, and nightlife experiences. And the first thing that popped in my head when I saw that was, wow, this is a really great website for a real estate company. But 2, wow, those businesses must really have struggled during COVID. Talk to us a bit about your experience with your business and real estate through the pandemic.
That's a fantastic question. So COVID was a shock, obviously, for everybody. And it wasn't what anyone could have imagined, with the restrictions and the regulations. And what made it more difficult was different markets and different governments in those local markets had different rules. So I had a portfolio in probably 10 states 2 years ago. And like you'd have, California, which was ultra conservative when it came to COVID. And they didn't force tenants to pay rent, and there was delays on that. They wouldn't allow tenants to open for business. Versus, Florida in the beginning of the pandemic was worried and concerned and had some restrictions, but after a while they decided to open up. And a lot of businesses and a lot of people, owners like myself, saw that and said, okay, while I respect California and some of these other governments are a little bit more strict, Florida is flourishing. A lot of people are moving there. A lot of people made that their new vacation spot to get away from their homes or wanting to have the ability to live a normal life, even though they understood the risks. And believe it or not, my entire portfolio, we had like 98 or 99% collection. We did not really get too hurt. We worked with tenants to help them on their obtaining their PPP loans. We helped delay their rent and said, look, if you can't afford it, obviously show us proof that your business is struggling. And then we'll work with you guys. We'll do a payment plan. We'll defer your rent and then let you pay it back next year over a period of 12 months or whatever it is. So, or there was some tenants that say, hey, look, I've been a great tenant for 10 years. Times are tough. Do you mind giving me a couple months free rent? And while I'm getting through this, and then I'll extend my lease for a longer term period. So the key to our success through going through the pandemic was the ability to maneuver and work with our tenants, and understand their perspective of what's going on and figure out a solution for both sides that was mutually beneficial. Because a lot of people sit there and say, look, the landlord should foot the bill, the landlord this, the landlord that. At the end of the day, we have bills too, right? Property tax, insurance, got to pay our lender. Our lender never came to us and said, hey, Robert, don't pay interest for 3 months. Don't even worry about it. We got you. That wasn't the case. So they understood the hardships we had. We understood the hardships they had. And we just found a happy medium for everyone to survive through it. And thankfully, everybody did. And like you mentioned on our website, restaurants, nightlife, hospitality, our tenants flourished. We, after the couple rough months, we ended up leasing up our entire Miami portfolio 100% and have all these new nightlife hospitality groups coming in from all over the country, all over from the world now, because Miami's becoming that new hotspot for the United States.
This is not to say that the pandemic is over, but as things related to COVID have seemed to slow down a little bit lately, we get hit with inflation and increasing interest rates pretty dramatically. How have rising interest rates impacted your real estate business and the acquisition process?
It's a great question. It's something I'm actually talking about daily. Even today, the 10-year and 5-year creeped over 3%. I think what's scary is not so much what the rate is, because, myself, I've been used to 4%, 5% rates when I first started. It's how fast they are moving. You typically don't see 100 basis points spread in 30 or 60 days. It's going up extremely quickly in order to fight off the inflation and try to slow down the economy. So I can't say, a lot of people say, well, Robert, interest rates, oh my God, it's going to, it's a game changer for the business. I said, look, at the end of the day, if you're in real estate redevelopment and if 1% higher interest makes or breaks your deal, you're doing the wrong deal. Just stop doing what you're doing. That's not to say be okay with higher interest rates, but it's just the cost of doing business. It is what it is. So yeah, has it affected me? Yes, in the sense that I don't want to keep paying more money, but does it make or break my business? Absolutely not. It's just it's another growing expense like everything else.
Are you changing anything about how you're approaching deals, the debt markets, or anything like that in the next 6 to 12 months? Or are you just really being crucial and conservative with your underwriting?
Yeah, I mean, typically myself, I don't ever leverage my portfolio more than 50%. That's just not something I've ever been comfortable with. So, for people that are highly leveraged or take outside money and they're making money off interest rate spreads or stuff like that, I'm sure it affects their business a lot more. But since I own my company myself and I don't pay outside investors, it really does not affect me in the sense that when it comes to new property purchases, I take advantage in the sense that if a seller is trying to sell a property in the ultra aggressive cap rate range that the market has kind of allowed us to do since rates have been so low over the past 3 to 4 years, I say, look, rates are now 4.5%, 5%. I'm no longer buying your 5 cap deal. I'm buying your deal at 5.5 or 6. So I'm using that to my advantage to try to push spreads on cap rates when it comes to buying a new property.
Explain for somebody listening that doesn't know or hasn't heard of the spread between cap rates and interest rates, why that's important and what it means.
Yeah, so why it's important in the sense that if you're borrowing at, let's say 5% is probably the new rate that's going around for these commercial loans. And it doesn't make sense for you to buy a property at a 4.5 cap because your leverage, you typically want to take out leverage so you can make the spread between your loan interest rate and the property's income stream. So you want to get your loan at 4% and get your income at, your cap rate at 5%. So you have that 100 basis point delta. But now if your interest rates are higher than your cap rate, then what's the point of buying the property? If you're just buying it for cash flow purposes, there's probably other investments at that point that you can get better returns than going and buying a single tenant.
What is your capital structure or your capital stack for most of your deals? You just briefly mentioned it, but are you the sole owner of all your properties? Obviously, you probably have some debt for those properties as well, like you said, at 50% loan to value, but you don't take any outside investors?
No, I never have. And it's not that I don't like partners or whatnot, but I have a very specific style to the way I like doing things and I've been pretty successful at it. So for now, there's no plan to bring on investors. In the next couple of years, the thought's been thrown around internally of doing a fund and raising money to grow exponentially. But I have a very big saying that pigs get fat, hogs get slaughtered. So I don't like to get too greedy too fast. So just taking my time to build the pyramid of the company from ground up, especially since we've evolved so much from, small mom and pop shop to a bigger real estate company. I'm taking things slow. I don't want to get ahead of myself per se.
I mentioned it before, but your website is one of the best that I've seen for
Thank you.
You're welcome. For a real estate company. What role do you think your website and the media presence that you have play in your deals? Does it make any impact?
Hey guys, I wanted to give a quick shout out to Trade Coffee for supporting the Investors Podcast Network. I've always had trouble finding fresh coffee at the grocery store because a lot of the time it has been sitting on the shelves for weeks and eventually goes stale. Trade Coffee sells the freshest roasted and ethically sourced beans from America's best local roasters. They deliver right to your doorstep with free shipping as often as you'd like. I got started with Trade by taking their simple quiz online. It was super easy as they asked me a few questions such as how I make my coffee, whether I'm a coffee expert or beginner, and if I add milk or cream to my coffee. The results matched me with the Nebula Dark Roast, and let me tell you guys, I cannot get enough of it. It was roasted right here in the US in Oakland, California, and it has a comforting and rich taste with added honey to help me satisfy my sweet tooth. Another reason I love Trade is because they support small businesses and ensure they're sourcing their beans from sustainable sources. Trade has delivered over 5 million bags of fresh coffee, and they have more than 750,000 positive reviews. If that isn't enough for you, Trade literally guarantees you'll love your first bag too, or they'll replace it for free. Right now, Trade is offering new subscribers a total of $30 off your first order plus free shipping when you go to drinktrade.com/TIP or click the link in the description below. That's more than 40 cups of coffee for free. Get started by taking their quiz at drinktrade.com/TIP and let Trade find you a coffee you'll love. That's drinktrade.com/TIP for $30 off your first order.
Yeah, for sure. Look, I up until 12 months ago, I had a private Instagram account. I didn't have much on social media. I didn't really think much of it because when you're trying to lease properties in a suburb of Atlanta, it's not really going to make or break you bringing in a tenant. But now that I've gotten into this higher profile food and beverage and hospitality scene and the major anchor players in these power centers, a lot of people are tracking social media and a lot more companies are seeing the value in TikTok and Instagram to be able to express their company's brand and message similar to mine. And, I bought a property in South Beach a month ago or so, and we pretty much leased it within the first couple of weeks. Just because of social media and that presence. So it's making a huge impact. The website's definitely edgy and different, like myself, obviously. And it's important to me because real estate has been such a cookie cutter, mundane business for such a long time. And, while it works for some people, that's great. I want it to bring the revolution and the difference of, there could be a new generation of real estate investors, a new way to look at things. You can have a beard and not wear a suit and go to the office and be okay with that. And there's nothing wrong with that. And there's nothing wrong with the other side, but this is just my way of doing it in the way I want people to see our brand going forward.
I have to say that's one of the things that I liked most about your social media presence. And when you guys reached out to come on the show, it really stood out to me that you kind of have that edgier brand. It's not necessarily my personal style, but what I do resonate with is that it's not the suit and tie kind of style. Like I'm wearing a backwards hat right now. That's kind of more my style. And I feel the exact same way that you do when it comes to, you don't need a suit and tie to be successful in real estate. And that's something that I'm trying to push with my personal brand as well. So I really, really like that you do that.
Appreciate it. Thank you.
A few of the properties that your firm Black Lion owns are strip malls or properties that are heavily dominated by retail businesses, with what seemed to be a general consensus over the past 5 years or so that Amazon and e-commerce businesses were going to destroy physical retail. What interested you in these types of specific properties?
That's a fantastic question. It's something, I battled around in my head during the pandemic significantly. There's some shopping centers on our website, I think, that are a little bit, they've been sold. We no longer own them. But what our focus went from was, let's not invest in the smaller strip centers. Those could potentially be more susceptible because if you're a new business coming into a market, let's call it a mom and pop business or a regional chain, you typically want to go near the big anchors that bring the big draws, Walmart, Lowe's, Home Depot, et cetera, et cetera. So I said, okay, if we're going to invest in this category that without a doubt has been heavily affected by all the things you mentioned, it's best to go in the best of class in that asset class. So if I'm going to buy a shopping center like the one I just bought in New Jersey for $50 million, it's got Lowe's, it's got Walmart, it's got Michael's, it's got Five Below, it's got Bed Bath, it's got every national chain, PetSmart, Wells Fargo, Panera, it's got them all. So if a customer wants to go to a property, more likely than not, they're going to come to mine because I have so many options. Versus if you go to a strip center with 6 tenants, they may or may not need that, or they may say, hey, I don't want to go to this hair salon, I want to go to this other hair salon that's part of the Lowe's property because I can go get something from the hardware store. I can go to my hair salon. I can go pick up groceries. You have all what we call synergy in shopping centers. Naturally, those bigger shopping centers have that synergy. So that's why I started shifting from, okay, if we're going to be in the real estate game, if we're going to be in the retail game that has these effects, we're going to go best in class, which is exactly where we pivoted, buying, a couple of these large power centers from these institutional REITs. And then the other part of the business, just so I can not have all my eggs in one basket, like you mentioned, was the high profile restaurant, food and beverage, where a customer is spending $125, $150 a person and wants that experience of going in person versus, buying it online. You want to take a date out, you're taking them to a restaurant. I mean, now you could probably date in the metaverse, but if you want the personal experience, that's where you would probably be going.
When I look at the states that you're buying in and you're investing in, Arizona, California, Florida, Illinois, New Jersey, and Texas, I don't really see a pattern of looking for landlord-friendly states. How do you consider the general legal favorability towards landlords or tenants when you're entering a market? And how do you analyze a market in general?
Yeah, that's another great question. So, you always hear from everybody, it's best to invest in Texas and Florida. They're more landlord friendly, state income tax, this, that, the other. And that's great. Don't get me wrong. A lot of my properties are now there. The issue when you're talking about making serious money in equity, if everybody is looking in the same market, like yourself, or a landlord friendly market, what opportunities are going to be left for me if everybody in the country is looking in the same areas? So while I've been lucky and great at finding great properties in great markets, there was a while where you have to go against the grain. A lot of the properties I bought were in Milwaukee or in the suburbs of Chicago, and markets that were depressed or heavily affected still from, the recession years ago. So it's that balance of going against the grain and saying, look, if I'm into this property for a year or 18 months, which was my typical MO when it came to these deals, it wasn't as big of a proponent for me because I'm not holding this property for 10 to 20 years. So I have to think of headwinds and, oh my God, what's this market going to turn into in 10 years from now? How's the government going to affect it? I'm thinking, hey, what's my business plan for this local demographic? Can I execute my business plan in 18 months? And if so, what's the next steps? That's how I think of it more than thinking about it from a longer perspective, where a lot of these investors do think about it like that.
One of the things that's different about commercial real estate is that usually, especially if you're doing industrial, retail, some of the types of assets that we've been talking about, is that you have businesses as tenants rather than individual people who are living there, which means that the businesses you're renting to need to succeed in order to pay you rent each month. What can you do as a landlord to help set up your business tenants for success?
Yeah, that's actually something that's on my mind every single time I redevelop a property, because like you said, it's not, hey, if I don't pay my rent, that's typically what you said for residential, that's where they live. They're going to pay their rent. If not, they're going to be sleeping on the street. Commercial is not the case. It's almost a luxury in the sense that if you don't provide a quality product, there will be 50 other property owners that will take your lunch and take your tenant. So what's super important for me is like the things I mentioned. Synergy within the property is super important for tenants to vibe with each other and to generate business and revenues off each other. Making sure your property's looking good all the time. Like, I don't know if you see on my website, like this Wynwood Jungle project that we're currently redeveloping. I spent $500,000 on fake florals on this property for the pure reason of it looking badass. But at the same time, it's an Instagram moment where I probably get 15 to 20 photos a day or tags a day at this property because they're so excited to go see the artwork. And what happens is when they go see the artwork and they go see the florals and they go see the new design, oh, I want to grab a smoothie. Oh, I want to grab a donut at a donut shop. Oh, I want to grab this. And it helps provide more business and attraction. So every project we're developing now, it's going to be a attraction or an experience. So that way it's not just, hey, I'm coming here for business, but it's an ambiance as well. And I think that's super important, especially now when you have so many options in Amazon where it's easy to get delivered to your house, that if you're not creating an experience, you're not going to be standing out. So Blackline, like my look, my hair, my beard, standing out is important. I think it helps out a lot.
You mentioned that you're relatively new to social media, but when I was going through yours, I noticed that you posted a video recently about purchasing real estate with a focus on cash flow or a focus on appreciation and equity. Talk to us a bit about this dynamic and which way you think is the right approach.
So this is an argument I had with Jalal, Grant Cardone, a bunch of people. Look, there's no right or wrong answer to cash flow or equity build. It depends where you are in your life and where you are in your career. For example, I developed my first project, I went in Atlanta, I think my net operating income on that property was like 130,000, 140,000. If I had the mentality of a lot of these people where it's like refinance and hold, $10,000 a month in net income was not going to pay. It doesn't even cover my property tax for my home today. And I had that mentality at a really young age that I'm like, look, cash flow is great whenever you have enough of equity to benefit off that cash flow. So for example, if my net worth is $1 billion and I'm making 5%, I can survive off $4 million a month perfectly fine if I have $1 billion. If I have, a $2 million net worth and I'm making 5%, that's $100,000 a year. What kind of lifestyle am I going to have by living off $100,000 a year when 30 to 50% goes to the IRS? So for me, it was like, hey, look, I want to keep building my equity, keep building my equity to the point where it's like, okay, I've retired, I've hit my number, which I'm sure all of us have a number, that when I hit that number, then I'll put it on all cash flowing assets and then I'll live off that income for the rest of my life. So some people like to do the plan of leveraging at every step and cash out refi. I'm not opposed to that. The reason I don't like it is sometimes people get a little too excited, over leverage, keep doing it. And then one time when, and especially commercial is a little bit more volatile than residential. But if you lose 3-4 tenants, if your cash flow strapped, if a COVID situation happens and you can't afford to pay the bills and you have that kind of leverage, guess what? You're going to be handing those properties back to the bank. So that's why I shied away from that cash out refinance and I just focused on equity building as much as I could.
What is your number?
It changes. I've already hit my number 10 times, to be honest, and it keeps growing. And I think every entrepreneur and every real estate person has that same drive. That's like, I hit my number. I could do more. Next number is $1 billion.
Is that moving goalposts? Is that good or is that bad? Some people talk about it's good, right? You have that increased motivation that keeps coming every time you hit a goal. Some people talk about it being bad because it's like you never have enough. So where do you fall?
It's funny because when I hit my first number, I would be running around, screaming, jumping up and down, and being the entrepreneur that I am, I'm like, okay, I could do more. Let's do more. Let's try the next one. I think it's good to understand a healthy balance between, if you're building the money for a reason, whatever your individual reason is. One of my reasons was I love traveling around the world. I love being able to give back. I love being able to buy the things I want to buy and throw parties every single year and enjoy my life to the best of my abilities, that you enjoy your wins throughout the process. If you're just going to be making the money to have a number up on a wall, it means nothing. So for me, I've always lived by the mentality of working hard and playing hard. So having that healthy balance between the two, the numbers just become, after a certain point, and I'll be guilty of this, it's just a number. There's more important things to life than trying to go after that $1 billion. Do I mind getting there? No, absolutely not. But if you're not enjoying life throughout the process and you're just going to sit there and look back after 20 years, like, oh, I hit my number, but I lost out on all my 20s and 30s. And that for me would be more disappointing. So I try having the balance of a lifestyle that I want, as well as trying to make as much money as I possibly can.
I did see the most recent videos and photos that you had from your party recently, and it did look pretty awesome.
Thank you. I appreciate it. So we have like a twice a year theme. I'm like a big Harry Potter fantasy, Alice in Wonderland. So yeah, it's that for me makes it all worth it. And then we had this event for autistic kids last week where we had a magician that went for 40 kids. And then we're throwing them a Harry Potter carnival. And, that's my way of giving back to the community and trying to help out because, as kids, and I'm sure like yourself, you had some fantasy growing up or some type of, whether it was Harry Potter, this or that. And like all the kids in us need to appreciate that and love ourselves. If not, again, it's like, what's the point? And I want to do whatever I could to give back to kids. That's a big thing for me, helping out kids, and especially ones that unfortunately have a tougher time growing up, to give them that excitement. Because growing up, Harry Potter, I didn't grow up with much money, but Harry Potter and that kind of excitement and fantasy really was like something I hung my hat on and really enjoyed.
Yeah, I think all of that stuff is awesome. And having seen what you're doing is really cool. Do you think money buys happiness? There's a lot of talk around that, and I'm curious what you think.
Absolutely not. No, it doesn't. Look, the grass, and I've gone through these iterations every year as my net worth has increased more and more and more. It doesn't, it doesn't, because, for example, I deal with a myriad of health issues and I couldn't spend $10 million tomorrow to cure them all. So for me, that was one of the biggest lessons in life, that money's not everything. because I've got enough money for tenfold, and I can't cure my health problems, and I can't go buy a wife. And I've been with my wife for 10 years, and I'm as happy as can be. But then I see my boys that are single, and all they're saying is, "Oh, I'm so sick of being with all these different girls, and I want to find a wife." It's like the grass is always greener on the other side. I think if you can't be content with what you have, and don't get me wrong, there are certain numbers that you want to get to. Like whenever I was selling Jordan shoes, I was not going to say, "Oh yeah, I'm fully happy." I want to make money. I want to be able to fly first class. I'm saying there's a healthy difference between, look, if you've got 100 million versus a billion, your life's not going to be that much different, is what I'm trying to say. But if your net worth is a million versus 50 million, significantly different. There's a point of a less appreciation, I guess, is what I'm trying to say.
That's exactly what I was going to ask next. I think there's a big difference, like you said, even to make those numbers smaller between, say, 100,000 and a million, or even 100,000 making 75 to 100,000 a year versus making 250 to 300,000 a year. I think there is a point where a scale where it does make a big difference in terms of life quality and happiness and things like that. And it's not that the money itself provides the happiness, it's what the money can get you or even remove from you for the stress. But then, like you said, there is a point of diminishing return where anything above that doesn't
For sure
make a difference.
Yeah, like my friend, like we always talking like, "Oh, Robert, do you want a private jet?" And I'm like, no, like the cost that goes into a private jet, whether I have the money or not, is ridiculous. Like I can go donate the money or help people out. Like I'm not going to spend $60,000 on a round trip flight to Miami. I'll just go buy first class for $3,000. Not because, call me cheap, but there's better ways to spend money. I'm not one of those guys that I'm just going to blow off money just because I can. So for me, that was one of the things that's why I said, like, there's a point of diminishing return. Do I want to fly first class to Europe and enjoy nice fine dining hotels? Absolutely. Do I want to be able to own my own home and not have to rent like I did for 7-8 years? For sure. There's things that you want to get in your life for yourself and for your family. And then after that, it's like, okay, what else do I need? I'm going to go buy a jewelry for $10 million. Yeah, not doing that. But so I guess it just depends on each individual person and what matters to them.
What are some of the mistakes that you've made along this journey of real estate investing and wealth building?
Look, it's knowledge. For me, it's not being knowledgeable enough about certain situations and being a gunslinger and just thinking I may or may not know everything, and it's led to mistakes. So also not scaling up fast enough. Like I said, I was very conservative growing up, and when I had opportunities like in Miami where I could have invested more, I took the cautious route and said, look, it's better to be safe than sorry, and the whole pigs get fat, hogs get slaughtered mentality. So I wish I would have scaled up a little faster. I wish that I would have expanded my team a little bit faster in the earlier years. But any small business owner, you're always fearful, right? Like if I'm going to shell out $250,000 for an attorney on salary, I'm worried because I have to pay that. So I think it was growing pains. It wasn't so much mistakes, but just growing pains and understanding things, and the amount of time it took me to understand things on my own. I know a lot of people now get mentors, and maybe that could have been a route that I went, but I never had a mentor. I've never read a book. I just kind of winged things on my own and learned throughout the years. So maybe getting a better knowledge base from the get-go, or 10 years, 12 years ago, you didn't see this huge influx like you see now with these podcasts and these Instagram things where people are signing up for courses. It didn't really exist 15 years ago. So maybe having a little bit more of that was what I would say.
As we near the end of the show and we wrap up, I like to turn the tables and let the guest actually become the host for a second and ask me a question. So Robert, what question do you have for me?
How did I do? No, I'm kidding. I mean, look, I would want to hear your perspective on some of the things I mentioned from your side. Like how do things in your business day to day run in comparison to how mine does?
What's interesting to me is I had a podcast. We're recording this. We started about 12:30 Eastern time, and I had a podcast that ended at 12:15, 12:20 right before this, and we chatted for about an hour and 20 minutes. And what's interesting is he had an entirely different philosophy than you. You're sticking a little bit more conservative, a little bit more 50% like loan to value type approaches to real estate, it sounds like. And he is more along the lines of do that cash out refinance. Anytime you have equity, leverage to 100%, take that money and reinvest it in another property. If you have any equity in a property, take out a HELOC or a cash out refi and put that money into more investment properties and scale that way. So it's really interesting to be able to hear, and I'm not saying your strategy's right or his is right. I don't know whose is right. And then it's probably right for different people, but I'm just really interested in being able to learn from people like yourself and him. It's great to be able to hear the different perspectives.
Yeah, and look, it's like I've said, there's no wrong, there's no right or wrong in either position. One just more risk adverse versus the other. I mean, don't get me wrong. I've leveraged. There's been properties where I've hard money loaned on top of my hard money loan because I did not want to lose out on an opportunity. There was a deal that I knew I could buy for, I think it was $6 million, and I could sell for 15 million in 18 months, and I did not have the money. So I went and literally got a hard money loan off my property, maxed it out, and then the new property I bought, I used that equity I hard money from, and then I got another hard money loan at 75% LTV just to buy that deal. So I double hard money. And while I don't recommend it because I was sitting there cringing every night, making sure that property went well, there's times where you have to make that push. And I think it's 100% right to do it. What I don't think is right is to do it in your entire portfolio.
Not even just your entire portfolio, which I do agree with, but it's also depending on where you are, right? Like you've already built substantial wealth. You don't necessarily need to take those risks. You might be trying to preserve wealth a little bit more, but people that are just getting started, they might need to take that risk in order to hit the goals and levels that they want to achieve.
Right. No, and that's very well said, because when I was younger, whenever I had less of a net worth, I was significantly less risk adverse. I was like, oh, whatever, because you don't have anything. So it's like, what am I losing? I just started with this. Now you get to a point, especially with the bigger dollar ones, like my recent property that I bought, I have a $25 million plus loan on it. And it's I was younger, it'd be more scary. Now, with the income that I have, it supports it and whatnot, but it's scary. You start getting loans that can hurt. If I have to pay a $25 million loan back, it can hurt. But if you got a $200,000-$300,000 loan, you could borrow it from a friend. If you have a friend, the banks will work. It's a different beast. So as you start building more net worth and you're used to a certain lifestyle, it's tough to go back and lose it. You don't want to lose it. So that's always for sure a lot more in your mind than in the beginning.
As we wrap up the show here, I want to give you a chance to tell the audience where the best place is to connect with you, learn more about you if they're interested.
Yeah, so the best place to connect with me is definitely Instagram. My Instagram handle will probably be posted up here, I'm sure, is the best way to get in contact with me, or through the website as well.
Yeah, I will be sure to put a link to Robert's social media and website in the show notes below for anybody that's interested in checking them out. And for anybody that's interested, I do recommend you at least go to his website and check it out, because it's pretty interesting for a real estate company to have that type of website. I really like it myself. So I recommend at a minimum, at least check that out. And then if you're interested in diving in more, I'll put Robert's socials as well below. Hey, thanks for joining me, Robert. I really appreciate it.
Yeah, thank you. I appreciate the time. Thank you for having me.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on our next podcast episode and new investing resources. What are your takeaways and thoughts about this discussion? Let us know in the comments section below.